Welcome and thanks for joining us today. Investing your money is one of the best ways to create lasting wealth. It can be intimidating to start investing, but it doesn't have to be. With little knowledge and effort, anyone can invest their money and start building wealth. In this video, we'll share 7 easy steps to invest money and create lasting wealth. Watch to the end to learn how you can make your money work for you. And if you're new to this channel, please don't forget to like, comment, and subscribe. Number 1, figure out what you have to invest. Before you begin investing, you need to figure out how much money you have to invest. This includes any savings or extra income you may have, as well as any investments you already have. To start, create a budget so you can determine exactly how much money you have to put towards investing. This includes your income, expenses, and any debt you have. Knowing exactly how much money you have to invest will help you make better decisions. Once you have an idea of the total amount of money you have to invest, it's important to consider how much risk you're willing to take. Are you comfortable investing in high-risk stocks, or would you prefer safer, more conservative investments like mutual funds or bonds? It's also important to consider if you want to invest a one-time lump sum or invest regularly over time. Knowing how much money and what type of investments you're comfortable with will help you build a successful portfolio and set yourself up for long-term wealth. Number 2, determine your investment strategy. Before you begin investing, it is important to determine your investment strategy. This will allow you to make the most of your money and maximize returns over the long term. The first step is to set your financial goals and determine how much risk you're willing to take with your investments. Consider your financial situation, how much you have to invest, your time horizon, and the amount of return you expect. Your investment strategy should be tailored to these factors. Once you've determined your goals and the amount of risk you are comfortable with, it is time to decide which types of investments to make. Depending on your goals, you may choose stocks, bonds, mutual funds, exchange-traded funds, ETFs, real estate, or commodities. Each type of investment has its risks and rewards, and you should consider carefully. You should also consider diversifying your investments across different asset classes and geographical locations. Diversification reduces the overall risk of any portfolio by spreading your money among different investments, which in turn helps to balance out potential losses with gains. Finally, remember to review your investments regularly and make adjustments as needed to ensure that your portfolio is still meeting your goals. With a well-defined investment strategy, you can enjoy the benefits of long-term investing while protecting yourself from short-term volatility. Number 3. Consider dollar-cost averaging. Dollar-cost averaging is a smart investment strategy that can help you build wealth over time. It involves investing a set amount of money into your investments regularly, regardless of the current market conditions. This way, you will buy more shares when the market is low and fewer shares when the market is high. Over time, this averages out the cost of your investment and reduces risk by preventing you from buying in at a bad time. For example, if you decide to invest $500 per month when the market is high, you'll buy fewer shares than when it's low. This means you're able to buy more when the market is down, increasing the potential returns of your investment. Additionally, if you're investing in mutual funds, you don't have to worry about timing the market perfectly, as dollar-cost averaging takes care of that for you. Ultimately, dollar-cost averaging allows you to slowly but surely build your wealth over time. And since it requires minimal effort on your part, it's a great way for even beginner investors to get started on building a portfolio that could eventually create lasting wealth. Number 4, decide which accounts to use. When you're ready to start investing, you will need to decide which accounts to use. The type of account you use will depend on what type of investment you're making. For example, if you are investing in stocks and bonds, you should consider using a brokerage account. With a brokerage account, you can easily access and trade stocks and bonds without having to go through a broker. This allows for more flexibility and control over your investments. On the other hand, if you're looking to invest in real estate, you might want to consider an IRA or 401k. These accounts allow you to invest in real estate through tax-advantaged plans. They are also great options for long-term investments since they offer tax advantages that can help you save money. Finally, if you're looking for a more hands-off approach, you may want to consider using a mutual fund. Mutual funds are great options for those who want to diversify their investments and don't have the time to actively manage them. With a mutual fund, Your money is managed by professionals, so you don't have to worry about picking individual stocks or monitoring their performance. No matter which accounts you choose, it is important to remember that investing comes with risks and rewards. Before you make any investment decisions, make sure that you do your research and understand the risks associated with the investments you are considering. By taking the time to understand your options and make smart decisions, you will be able to create a long-term wealth plan that works for you. Number 5. Avoid these common investment mistakes. When it comes to investing money, there are plenty of mistakes to be made. It's important to recognize some of the most common mistakes that people make when it comes to investing in order to ensure that you don't make them yourself. One of the most common mistakes that people make is investing without doing any research. Before investing your hard-earned money, you should take the time to understand what you are investing in and what the risks are. It's also important to consider the fees and costs associated with investments, as these can eat into your returns. Another mistake people make when it comes to investing is over-diversifying. While diversification can be beneficial for many investors, too much diversification can actually be detrimental to your returns. Diversification should be done within reasonable limits in order to reduce risk while still allowing for the potential for growth. Finally, one of the biggest mistakes people make is letting emotions get the better of them. When making investment decisions, it's important to be rational and disciplined. It's natural to experience fear, doubt, and excitement during different times in the market, but reacting emotionally can lead to mistakes that can cost you money. By avoiding these common investment mistakes, you can increase your chances of achieving your financial goals. Take the time to do research and be rational when it comes to making investment decisions, and you'll be better positioned to create lasting wealth. Number 6, review your investments regularly. It's important to regularly review your investments to make sure they are still aligned with your investment strategy. As the market changes, so should your investments, in order to stay on track and meet your goals. When reviewing your investments, take into account factors such as economic trends, inflation, and taxes. Start by assessing your portfolio performance. Keep an eye out for any sudden drops or large gains, and adjust accordingly. If you're not confident in doing this yourself, it's best to speak to a financial professional who can help you assess your situation and make changes if needed. You should also be aware of the fees associated with your investments. Make sure you understand what fees you're paying and that the fees are reasonable in comparison to other options. Additionally, if you have multiple accounts, be sure to consolidate them into one account to help simplify your tracking. Finally, don't forget to reassess your investment goals as well. Evaluate if your current investment strategy is meeting your goals, or if it needs to be revised. Also, consider whether you need to readjust your risk tolerance level or invest more capital to reach your goals. By taking the time to review your investments regularly, you can ensure that they remain aligned with your goals and stay on track for success. Number 7, consider working with an advisor. Investing your money wisely and growing your wealth can be a difficult task to tackle on your own. You may want to consider working with an investment advisor who can help you guide through the process and provide expert advice tailored to your individual goals. An investment advisor can help you develop an appropriate portfolio based on your risk tolerance and desired return rate, as well as regularly review your investments to ensure they are still in line with your goals. They will also be able to provide valuable insight into current market trends that you may not be aware of. Additionally, working with an investment advisor can provide the peace of mind that comes from knowing your investments are being handled by a knowledgeable professional. When selecting an investment advisor, make sure to do your due diligence and find one who is registered with a Financial Industry Regulatory Authority, FINRA. Research their background and qualifications, as well as any potential conflicts of interest that could impact their advice. Also, make sure to ask about the fees they charge and how they're compensated. Ultimately, whether or not you choose to work with an investment advisor is up to you. But it's worth considering, particularly if you have limited experience with investing and want to increase your chances of achieving your long-term financial goals. Investing your money to create lasting wealth is an important part of financial security and success. By following the 7 easy steps outlined in this video, you can create a sound investment strategy and make sure that you are on track for long-term financial success. Remember, that patience and dedication are key components when it comes to investing. So stay the course and invest in yourself to ensure that your money is working hard for you. Hope you find this video informative and helpful. If you have any comments, feel free to leave them in the comments section below.